Let's talk about one of the most backward-sounding strategies in all of finance. We're going to get inside the head of an investor who built a multi-billion-dollar empire on a principle that, honestly, just feels wrong.
See, this is the thing. Jeff Yass loses on most of his trades. And this isn't because he's unlucky or making a bunch of mistakes. No, he loses because his entire system is built to do just that.
And when you see it in practice, the rhythm of that system, it looks a little something like this.
A small bet is placed. It doesn't pan out. It's a loss. Okay.
Here's another bet. And another small loss. This is totally normal. It's actually expected.
And again, this is just the cost of doing business. You collect the data, you update your model, and you move on.
And again, most people would have given up by now. They'd feel like a complete failure. But this strategy isn't about feeling right. And then this happens. One single massive win that pays for all those little losses. And then some. This one outcome, it changes the entire equation.
So how in the world do you turn a pattern of constant losing into one of the most successful trading operations on the planet? Well, it all starts with Jeff Yass and the firm he co-founded. This is Susquehanna International Group, or SIG as they're known. Now, they're not managing your uncle's retirement fund. They are a proprietary firm. That means they're placing these huge bets with their own money, taking on all of the risk themselves. And the scale they're doing it at, it's just mind-boggling. Just to give you a sense of their dominance, get this. Back in 2020, SIG was responsible for trading about 25% of all U.S. options. That's a quarter of the entire market. So these guys are not some small-time players. They are a market-making giant, and they built it all on a philosophy of losing.
So, what's the actual logic that makes this whole machine work? It has nothing to do with being right more often. It's about understanding the huge difference between what's common and what actually matters.
This quote right here, this is the key that unlocks the entire strategy. Think about it. The most common thing that happens can be a small loss, over and over and over. But if the average of all your bets, all those little losses plus those incredibly rare massive wins, if that average is positive, you're going to come out way, way ahead.
Here's the contrast in black and white. Most investors, they're chasing a high win rate. They want those small, consistent gains that make them feel smart day in and day out. The Yass approach completely flips that on its head. It says, I will accept a very low win rate. I will embrace losing a little bit all the time in exchange for those rare but absolutely game-changing home runs.
To actually pull this off, you have to have a relentlessly analytical mindset. You have to completely strip the emotion out of losing and just see it for what it is, another piece of data.
A loss isn't a failure, it's just the result of an experiment. You formulate a bet based on a probability model, you execute the trade, you watch what happens, and if it's a loss, okay, that information just gets fed right back into the model to make it a little bit smarter for the next time. It's a cold, clinical, repeatable loop.
And this just perfectly shows you the inverse logic. I mean, most people would do anything for a strategy that wins 90% of the time, but Yass understands that if those 10 losses are big enough to completely wipe you out, then your 90% win rate is actually a death trap. He's not focused on the 90 small wins that make you feel good. He's obsessed with the one catastrophic loss you never saw coming.
And look, this philosophy isn't just for trading options. It's a fundamental way of looking at probability and making decisions that applies to, well, pretty much everything. And a story about a game show proves it perfectly.
So let me ask you, on a show like Jeopardy, what could possibly be more important than knowing the right answer? I mean, that's the whole point, right? Well, not according to Jeff Yass.
So his longtime colleague, a guy named Todd Simpkin, actually competed on Jeopardy, and everyone at the firm was obviously really excited. But when Simpkin got back to the office, Yass had this really strange lack of interest in whether he knew the capital of Kyrgyzstan. He only wanted to know one thing.
That was it. He didn't care about the answers at all. He saw the entire game as a pure probability problem. Given the scores going into the final round, what was the mathematically optimal wager? For Yass, knowing the right answer was secondary to making the right bet. That's the mindset in its purest form.
Okay, so this all sounds perfectly logical. It's mathematical, it's rational. So why doesn't everybody just do it? Well, because for most human beings, actually executing this strategy day after day is psychologically unbearable.
Our brains are just not built for this. We are hardwired to look for consistency, and we hate being wrong. We crave that little dopamine hit of getting it right. So a strategy of constant, small, paper-cut losses just feels like being told you're an idiot all day, every day. It's emotionally draining to just sit there and wait for that one big win that the math promises is coming eventually.
And that really is the crucial distinction, isn't it? It boils down to what you're trying to achieve. Is your goal to maximize your profit and loss over the long run, or is your goal to maximize your feeling of being correct in the short term? You can't have both. This is a system for people who only care about the first one.
Which leaves us with this really fascinating question. If a system is proven to work, if it's perfectly logical and backed by cold, hard math, but our own psychology makes it impossible for us to actually do it, what does that tell you about the real limits of being a rational investor? That's the wall most people can never, ever climb over.